Welcome to my channel. I'm the covered call guy, and this is my journey to creating a $120,000 per year passive income portfolio, specifically using covered call ETFs. Before we get started, legal disclaimer: all content presented in this video is for informational and educational purposes only and should not be considered financial advice. I am not a licensed financial advisor, broker, professional. The information is based on my personal opinions, experience, and publicly available sources at the time of publication and may not reflect current market conditions or individual circumstances. Trading investments involve substantial risk, including the potential loss of your portfolio. You should always conduct your own research and consult a licensed financial professional before making any investments. All views are my own and does not represent the opinions of any other party or organization. I am just some random idiot you found online, and I could be completely wrong. Please do your own research. Please fact check. Again, this is not any recommendations. This video is just what I've put together, what I found. So I could be completely wrong. I could be giving the wrong information. So please do your own research. With that out the way, today's video is going to be a deep dive on cover calls and what makes a good cover call good and what makes a good bad cover call bad, and what we should be looking for, what my criteria is, and what I've looked for in a cover call ETF so I can either buy it or stay away from it. So this is my breakdown. All right, a deep research review of cover call ETFs landscape, separating sustainable strategies from new traps. All right, so the cover call ETF landscape, right? The cover call ETF market has grown the past, last 5 years, and we have to be able to separate what is sustainable total returns from yield traps, because yield trap is just going to completely erode your principal. Some cover calls have given most cover calls a bad name, and eventually will go to zero. I would say that most new investors choose the highest yield just because they see the highest yield giving 50, 80, 100%, and eventually they learn the lesson that, hey, the stock price is down 50, 70%. I've exactly gained nothing, and what's happening. So we'll be going through that here in this video. All right, so the fundamental trade-off, income versus total returns, right? So we don't want the cover call ETF to sell 100% of the upside, right? Because then if you maximize income, you are capped. And so your NAV, which is net asset value, it will decay. We call it NAV decay, right? The asset goes down, but you get a high immediate payout, but it will lead to structural NAV decay, right? So, quote unquote, I put this video and I put the top tier list, the top tier strategy, right? We want sell out the money OTM calls to retain partial upside. That way the NAV can be stable and or grow. And we have sustainable payout, right? We want to preserve the NAV. We want to grow the NAV. That's the whole point, right? So we have to be careful when choosing a cover called ETF, right? We don't want them to just max the yield, juice it out, and completely capped. We don't want that. We want to stay far away from that, because then if the stock prices drop $5 and it paid out $5, what exactly have you earned, right? And over the course of time, it's eventually gonna go to zero. So deconstructing the black box for this, I just say black box because black box hold all of the information. Is indestructible. We want to pry it open and see what's underneath the hood. We want to see how these cover call ETF operate. We're looking for specific standards, right? We want to make sure the cover call is has a great strategy behind it. It has a strategy that can provide long-term stable, reliable payouts. So number one, the option strategy, we have to look for it. We call it the moneyness, right? Moneyness refers to option strike price relative to the current market price, right? So this is the single most important factor for NAV growth, right? At the money, if they're selling at the money, it will generate the most income, but you are completely capped off, right? So if the bull market just jumps and starts going up, your shares are called away, right? It's gonna force that fund to repurchase them at a much higher price, and that will erode the NAV, right? So we don't want that. You want to stay away from that. Out of the money, right? The strike price is much higher than the current price, and so it generates a smaller immediate premium, but it retains all of the upside between the current price of the stock and the higher strike price. So the fund can grow and participate in the market rallies. Right? This is a fundamental to sustainable total return strategy. And some of those is JEPI, GPIX, and SPY. Great funds. Love them. Now, number two, the overlay structure, the coverage, right? This refers to how much the portfolio is being covered by co-options. So we have to ask ourselves, is it a blunt instrument or a flexible tool, right? So let's say 100% systematic overlay, right? It covers 100% of the assets every month, no matter what, right? That's a blunt tool, right? It's best for nobody, right? The only reason people buy this is because you're a new investor and you think, oh my God, this is the highest yield. I can get the most payment. But they don't see that your portfolio upside is fully capped and you have no NAV growth. And in fact, your NAV is probably going down every month during the payouts, right? Maybe the partial / growth overlay, it covers a portion, 50% of the portion, and it is still a structural compromise because you might not be able to have that growth, right? It's left uncovered. This is a little bit more set and forget, and it's just it is a little bit more simple, but it doesn't always allow the fund to participate. It's a little bit more passive. And then we have the active dynamic overlay. This is where you have to trust the fund manager and you have to trust the strategy. You have to trust that they can execute, right? A manager tactically decides when and what to cover. Is the most flexible approach. The fund manager can sell calls in volatile markets where the premium is extremely high and or sell fewer in rising markets. Right? Investors need to trust management to optimize income growth trade-off. Some example is Divil, which has been doing very well. GPIX, which has shown it's relatively new, but has shown that it can do very well. So, going from 3, I would say this is the best. Then if you want to kind of play around and cover call funds like this, it's not bad, but we want to maximize income. The whole point of cover call ETFs is to maximize income while preserving the NAV, and this may not always do it. And then we have, I would say, the worst one, where you can maximize the income, but you're trading off the stock price for it, which not great long term. And then number 3, the underlying holdings, the assets, right? We want the ETF to hold great companies that have great profits, great revenue. Everybody knows the brand. Too big to fail. Has a moat, right? Is completely dominating, right? So the low risk one would be index replication, where the fund simply buys the stock in broad markets like the SP 500 or the NASDAQ, right? Some examples that is SPY, QQI, QYLD, which I know it's a little bit, kind of saying, oh, it's a bad, but it does. And I'm just using an example, right? It does replicate, but it doesn't make it the best. It's just an example. And then we have the active defensive portfolio, which is medium. This would be the Divil, GPIX, right? So 2 combinations here is it needs to have a good fund manager, and it needs to have good strategy so it can execute perfectly, right? The manager first builds a custom portfolio of stocks, low volatility, high dividend, then write calls on them. This introduces a second source of potential alpha or risk, which is the stock selection. But most of these, right, it just buys the index right here. So medium goes back to low, medium, right, depending on how they can execute. And then we have the very high risk, right? For example, I own BTCI, and what this is it's basically a speculative. This would be your satellite holdings, high conviction, but it is you're speculating on the asset, because Bitcoin is really a speculative asset, right? It can swing 20, 30, 40 grand up, just as it can swing 20, 40 grand down. So it is very high risk because it's not exactly a proven, right? I do own Bitcoin myself, and I own the cover called fund. So it's a high conviction satellite fund. This shouldn't be your core, right? This should be, you know what? I can dollar cost average is down today. I'll put whatever, $100 or $1,000, whatever you have, and that's like, you know what? I'll just buy a little bit since it's down. Anatomy of a top tier ETF, right? So top tier funds are designed for sustainable total NAV, which is total return, which is NAV growth plus distribution. Am I saying that right? Okay, whatever. All right, you see the words here. All right, they share these characteristics, right? So you want to grow the NAV, you want to have total return focus, you want to be tax efficient, and you want to have strategic soundness, right? So grow the NAV, structurally designed to allow the NAV to appreciate, right? Total return focus, right? We don't want to be chasing yield. We don't chase the yield, right? Chase the strategy behind the fund, and chase what the fund actually holds. That's what we should be looking for, right? And tax efficiency, section 1256, I have a slide below that's going to tell us exactly what it means. All right, so what is section 1256 tax advantage? Before I go on, I just want to say again, I am not a tax professional. Please consult a tax professional if you need tax advice. This is just what I found online. I fact checked myself, but I could still be wrong. So again, please do your own research. Okay, this is a special rule in the U.S. tax code. It is the most critical differentiator for investors in a taxable account like myself. So standard fund, JEPI, DIVO, right? It's taxed at ordinary income. You're taxed just think of it this way. You're taxed as a W-2 worker. You're taxed as a regular employee. W-2 workers are taxed at the highest rate, right? And then we have GPIX BI that uses section 1256. Well, what is that? Right? All gains, regardless of holding period, get a special 60-40 blended rate. 60% is taxed at the low long-term rate, and 40% is taxed at the high short-term rate. So we get more tax benefits. We keep more of our money, right? For an investor in a 32% tax bracket, 50% long-term rate, the standard fund is taxed at 32%. You're losing right off the bat 32% of your money, right? So while the section 1246 fund is effective tax rate is only 21.8%, right? Out of $100, you're losing $32, right? That's a lot of money, especially if you have thousands or millions, right? Anatomy of a rejected yield traps. Oh man, yield traps are structurally flawed. They prioritize a high advertised yield above all else. I'm sure a lot of you can name a cover call ETF right off the bat, right? Those yield max products, they're no good, right? They prioritize a high advertised yield above all else, which can lead to destruction of investors' capital. Oh man, like I'm sure you guys know exactly what I'm thinking of, right? I won't name names. Oof, but they have structural NAV decay, destructive return of capital, right? when you distribute extremely high returns that is not funded by profits but by returning an investor's own principal back to them minus fees is an illusion of a yield that is destructive in a flat or down market, right? Plus the high fees plus flawed strategy, right? The fund managers say fund manager strategy is just yield, just try to just churn out money, but it will destroy the NAV, right? It will not have any performance and guarantees, and it will guarantee a long-term loss, right? Again, the high risk, the UMax products, a lot of people, a lot of new investors just look at the yield and they fall into it and they're like, oh my god, I'm gonna get paid so much, I can retire off this, I don't need a lot, I just need $100,000 and I can make back $100,000 with $100,000 invested. There's a massive trade-off. That is your stocks going to zero. No long term, it's extremely short term. So you might be getting $100,000 maybe the first year, and then the next year you get 80, and then you have that 50, and then 40, and then 30, and then 10, and then 0. Okay, so we're using QDevo bull case, a strategic ROC fund, right? So QDevo's NAV is growing, yeah, it's 12%, yield is 100% return of capital. That is not a contradiction, it's a specific hybrid strategy, right? So there's good return on capital, and then there's bad, destructive, right? So let's look at QDevo to see if it's a good one, right? 100%, it's a high, it's all of it. It's a high number, right? So that should be red flags, right? Total return engine, NAV growth, right? So QDevo holds growth stocks. In a strong market, these stocks appreciate, driving the NAV up. I believe it's almost plus 20% all-time high. And this is the total return part of the strategy. And then let's look at the cash flow, right? Strategic return on capital. These growth stock pay almost no dividends, 0.75, to fund the 12% yield. The manager sells a portion of the gains to appreciation and returns it as cash. This is return of capital. ROC distribution. Okay, distribution. Conclusion: this is a tax deferred strategy, so we're just delaying the taxes. Okay, we're not going to pay it now, well, in the future, or when we sell the stocks. Okay, we gotta look. All right, it's 100% ROC. What is happening with the NAV? And so far the NAV is positive, so that means it's good. That's a good thing so far, right? So QDevo is something you want to be actively managing yourself. You have to see, all right, this month payment, is it lower, is it higher, is it the same, how's the NAV doing, right? It's total return fund that manufactures a high consistent tax advantage cash flow from its own capital gains. So then we have to look at how it does in a downturn market. Will it have to sell off its stocks, and then that will drive the NAV down? So this is one you have to look at, because 100% ROC it should ring a red bell, right? Red flag. Oh, okay, that's a lot. How's the NAV doing? Is the payment lower, right? We don't want to destroy the NAV. Okay, and then this is just my sample portfolio. I'm using my own. This is a sample portfolio of the top tier core, GPIX and GPIQ. I think these are the best of all worlds fund. They combine active management, the lowest expense ratio that I've seen, and superior 60/40 tax treatment. And then we have the top tier hybrid. As of now, we have to keep an eye on this. This is a total return fund. It holds growth stocks and manufactures a high yield by distributing its capital gains, right? Tax deferred return on capital. All right, it's strategic. It's not a yield trap yet, but we have to look. We have to maintain. We have to keep an eye on it. And then the tactical, Maggie and BTCI. These are not diversified core hunting. They are speculative spice, right? They're my satellites. They're transparent and effective at their stated goal, generating high income from concentrated high volatility themes, Max 7 and Bitcoin. So their NAV has been preserved while paying such high income every month. So they're doing very well right now, but they're listed as top tier because they're able to pay out such high payments and preserve the NAV and grow it. All right, so this is just a little bit of information here. All right, top tier analysis. When I say top tier, it's basically a list of funds that I think are doing pretty well, that I personally like. GPIX, GPIQ, JEPI, JEPQ, QYOG, XYOG, DIVO, SPY-I, QQI, KNG, iSpy. Right, top tier funds are all not the same. They compete on active management, tax efficiency. So not all cover calls the same, right? We have to look at JP Morgan's active but tax inefficient ELN funds, right? So the JEPI and JEPQs, right? They're taxed at ordinary incomes, right? We prefer the 60-40 blended rate. We want to keep more of our money. And here I just made a list. Right, JEPQ, ordinary income. JEPI, ordinary income. SPY-I, QQI from NEOS. 60-40. IWMI from NEOS, 60-40. These are my top tier lists. I've been digging and doing a few research and deep dive. And this might be my next purchases, so I will be doing a little bit more. My next purchases will most likely be from the NEOS. I'll be looking more in the Russell 2000 index. I want to get my hands in the Russell 2000 index, so we'll see how that performs. I'll be tracking it. And then the rejected, right? Rejected tier list, right? Rejected funds fail the top tier criteria, often prioritizing high yield at all costs. NAV decay, we don't want it. We just stay away, right? It's unsustainable. These are you're gonna get the payment by the same time the NAV falls by that same amount. Absolutely no point, right? I don't think these are sustainable, right? I mean, 80% yield, not you would need to be in a forever bull run, and even then it's not guaranteed. It's not. Everybody would be millionaires, right? So rejected tier list. QLD, 12% yield, 100% at the money overlay. It's guaranteed NAV decay in a rising market by selling all of the upside. Yeah, I mean, I'm not gonna go do the entire list, but you can see here it's I would stay far away from these. I personally would stay far away from these. It's just you're trading the risk of NAV decay for the payment, and long term it's just not worth it. All right, 3 steps checklist for evaluating any fund, right? Step 1, check the engine, the strategy. Step 2, check the source, the payout. And step 3, check the tax, the location. Right, the engine, what's behind it? Is it at the money? Is it a yield trap? Is it out of the money? Is it partial dynamic overlay to capture some upside? The source, the payout, where does the yield come from? Look for return on capital, right? High return on capital in a decaying fund is destructive, right? High return on capital in a growing fund like QDivo can be tax deferred total return strategy, but we got to know how they perform every month, the payout. And then the location, right? The tax, right? Is it a taxable account? If yes, this is critical, right? JEPQ uses ELNs. It's ordinary income. We don't want that, right? So we want to be favorable for taxes. And then this is just a little extra piece of information here for tax advantage accounts like IRAs and 401k and a tax sheltered account. The tax inefficiencies of ELNs is irrelevant. Obviously, you're not going to be taxed down. For JEP and JEPQ, you know why the ELN flaw, the ordinary income doesn't matter inside an IRA. Investors get full benefits, right? Their 0.35% expense ratio is extremely competitive. Devil is also an excellent choice here if investors prefer a more concentrated dividend growth focused portfolio. Devil is one of my favorites. I love it. And then announce for taxable accounts like myself, right? I want that 60-40 blended rate, so I'll be looking for GPIX, GPIQ, SPI, QQI. These are the best of the best. Extremely low expense ratio for GPIX and GPIQ, and then right off the bat, SPI and QQI. They also offer the same, but at 3 times the rate of expense ratio. So that is something to consider. And then for tactical speculative holdings, right? So these funds should be used only in small tactical allocations. Right here, I would suggest under 5%, but for me myself, I'm doing about just no more than 10%. I am going to take on the high risk because I don't mind the swing. I don't mind the upside or the downside to it. I would just dollar cost average. My goal is to have $1,000 per week for Maggie and $4,000 a month from BTCI. So I will be increasing the allocations until I reach my goal. Then I will probably start building up other positions so I can draw them down to a 10% each. And of course, the yield max. I'm not a big fan of it. Extremely terrible products in my opinion. All of them has some nasty K. It's basically gambling at that point, right? Not an investment. And then my final warning, right? Investors should not be fooled by yield, and investors should never select an income ETF fund based on its advertised distribution yield alone. The highest yield almost always belongs to the most structurally flawed products. Okay, a 50% yield from TSLY is meaningless if the NAV drops 70%. You've gained nothing, right? So a 12% yield from a flat or declining fund is an illusion. I have to be careful of my QDevo, right? The only metric that matters for long-term sustainable wealth or total return and after-tax total return. All right. Again, this is not financial advice. Do your own research. This is my criteria. This is what I've put together and what I found online. Again, do your own research before making any financial decisions. Facts could be wrong, could be outdated. And I hope you've been able to make better choices after this video. So stay away from the highest yield. Make sure it's good products. Make sure it's a good cover call that isn't just advertising its yield. Has great underlyings. Consistent payment. No NAV decay. Catch you guys in the next video.